yɛde nsɛm anomuayɛ ɛbrɛ.
The man in this picture.
Hello. I was your voice saying. Hope to be out here fine though. I rather send you call there.
Yamiadom no empire boy and tier for so empire boy, yes.
That's good.
Yes.
And that's so yes, I be more. And hopefully you me pass information with my body pa.
Yes.
So I think so Opa over to my recap from last time. Before we get into the deep of our topic today, we can go over some of the basics of some of the the recap from the last time, just kind of refresh everybody's memories.
Oh, okay. Yo, I cheer for yes, I am acquire by BM. And you remember last week, more year no man no. The more questions more the no, and a boa majumadi so very interactive. Na yes, young kwana ya kasa. Nti yes, I am acquire ba na mama who say. So, any questions be physical, some anything you can call into 240-280-2633. The number again is 240-280-2633. And now say be from Ghana. Na which me asane wo question no through WhatsApp. I was 510-931-0946. The number again 510-931-0946. Once again, Yamamwa Kwaba too, and the Jumadie no, Yadamwase de Bia Dano Musanya Adaje, na Moni Asia every Monday Bia no at 6 o'clock. Na Janimdia Kakranya, Miso Diamaya, no, our ultimate goal, Nissa Pasea, Nimuina, Esha, not Babia, mistakes Kakra war, away sitting Yina, no, ya try, sir, Yesika Sam, Yadibia, no, about 2 years. Until last week, and also for the past several weeks, the main focus is here is investment, because at the end of the day, I say a PBB added to baby kakra. In the future, we between follow on it. Maybe ye nimuena ya be retire, and now say and your retirement cry ye nimuena bibi betoa untumi nya adwuma biem. And when you're unable to work what will be your source of income? No, it's in you're spending more time about investment. Now the kakraso to what just for say BB ABC life event BBC a bio hopper utofie a bio hokra na oyirawo a bio hokra na womebe school. How do you fund all these life change events? AC a bremono. Intina share with us some of these things and send a be fully prepared just in case retirement ba, just in case a BBC na say Mijay Juma, I have something that I can follow. Until last week, you focus more on your friends stocks. This week, Nyamiya Dumwa, we be move from the stocks and alcohol different, but the year can investment vehicles share with us. A bio has stocks in your good for you. Maybe real estate will be good for you. Maybe investing in CDs will be good for you. Maybe investing in savings bonds and asset bonds is good for you. In some year this is like the right fit, and I said this is way not no. But the general information. By the end of it, seek a financial advice or an expert to guide you in every decision. Mostly our stocks and the account was the questions but na stocks are risky. Yes, it is risky. Yes, before you get into stocks, but more than say diversify your portfolio. Kakra oha, just in case say we market cut down, at least some areas able to me to pick up. Yes, I say the two areas are between sika from the stocks and the appreciation in the stock value nankasano me turn $10 5 years time now it's maybe like $1,000 a Hong Kong menya sika the dividends are menya also no and so in summary no in stocks no so wo bi a wo akukudro na you can weather say at the end of now if you're not going to pass out there, then maybe it is the right fit for you. But who needs akukudro na maybe go in but calling kakra. Just a recap on last week in your maybe can once.
Okay, boss, thank you very much. I think you did a wonderful job explaining and summarizing everything that we discussed last week. So, with that said, if there are no questions about what we discussed last week, now we can move forward and try to pick on the new topic of discussion today. As we mentioned last week, we discussed stocks, right? And stocks is something that we all know is one powerful way to be able to invest and grow and build wealth, right? But as Brother Asiem mentioned, stocks investment may not be for everybody, right? It can be a component of your overall investment portfolio, but it may not necessarily have to be. Maybe you are not somebody who may really indulge in stocks all that much. In that scenario, as you mentioned, you can also invest in a different form of investment.
Mm-hmm.
So the other investment that's also very popular that some people also invest in are bonds, right? So oftentimes you hear stocks, you hear bonds, you hear stocks, you hear bonds. They kind of go hand in hand together, right? And there's a reason why they both exist, and there's a reason why they both can be a part of your portfolio, right? We mentioned last week that yes, stocks can be very risky, depending on how you invest in that stock. If you choose to invest all your money into one stock, your risk is significantly greater because we all know that there is no guarantee in this life when it comes to a business surviving forever. We've seen established businesses that have failed because of managerial mistakes or because of something that happened that crippled that company, right? But there are also a lot of companies that are very, very strong. So instead of just putting all your money into one stock, you can diversify your money across multiple company stocks, thereby limiting or reducing your risk. Right? As we mentioned in the background last week and the week before, whenever you go and buy stock, you are buying ownership in a company. Let me be very clear. Whenever you go and purchase stock, you are buying ownership or equity in that company. That's why stocks are called equity instruments, right? Meaning that you are buying a share or you're becoming a shareholder of that company. You are becoming a part owner, meaning that your risk will be high because now you are sharing in the ups and downs of the company. If the company does well, you will do well. If the company does not do well, eventually you may not do as well, right? And there are some companies that will pay out dividends consistently, right? Because they are more established. It may not be as high of a payout, but they can pay you more consistently because they're established, right? There are some companies that are maybe starting out new and they need more money, right? But because they don't have that track record, they are willing to pay more because they need those funds to be able to what? Invest and grow their business. Now we can focus on bonds, right? Whenever you hear bonds, think of debt, right? Because bonds are a debt instrument, right? Meaning, just like a stock where you go buy and you are not part owner of the company, a bond does not work like that. A bond works like you go to the bank, you take out a loan and say, I'm going to pay this loan back. The same thing way a bond works. That means a company needs to raise money, right? So they'll come to you and several other people or the community. And so maybe they want to go to the bank to borrow the money, but maybe they don't have great credit to be able to go borrow money from the bank. They say, you know what? I'm going to try to raise money through the community or through other people, right? So they come to you and say, you know what? This is my company. We have a lot of good potential. We're a new company, but we can grow every year by this one, by this month. So you can see that the company has a lot of potential. So the companies, you know what? We're going to issue out bonds, meaning that this is a debt instrument. So let's say you give us $10,000. That $10,000 is a loan, and we promise to pay you back, the loan in, let's say, 10 or 15 years, depending on whether it's a short-term bond or long-term bond, right? You have some bonds as short as 1 year. That could be a short-term bond, or up to 3 years. It can be considered a short-term bond, right? You can have some bonds that are 10 years, right? Maybe from 1 to 10 years. They can be considered intermediate bonds, right? Or you can have some bonds that are issued for more than 10, 20 years. Those are considered long-term bonds, right? So the company says, okay, well, you give us $10,000 and you are buying this long-term bond. And this here is a loan. So that means we are going to hold that money for that 20-year period. But the whole 20-year period that we are holding that money, we are going to pay you a fixed interest on that money, right? Whether it's annually or whether it's semi-annually, maybe every 6 months, or some pay every month, right? So they're going to say, as long as we hold this bond, we are going to pay you a fixed interest rate on that bond, right? Which is a great thing, right? Maybe your money's sitting in the bank, it's not doing anything. You can take it, you lend it out, and you are now getting interest every single month until the term of the bond comes due, and the company will pay you the entire amount of what is due to you. So if it's $20,000 for 20-year term, in 20 years, they will give you back your $20K. But all that 20 years, you were collecting interest, right? And you get to select what interest rate you feel is conducive for you, right? They're going to lay it out, hey, we can pay you 3%, we can pay you 4%. But this is a fixed rate of return, right? And a lot of people like bonds because of the safety, because you are getting back guaranteed fixed interest payment, right? But don't forget, as we discussed last time, the more safety an investment brings you, the less return you can expect to receive, because it's a trade-off. Does that make sense? It's a very, very important thing to understand. That's why a lot of times when people are trying to build a portfolio of an investment portfolio, they have some stocks in there, they have some bonds in there, they have some real estate in there, they have some commodities in there. There are different things that make up the portfolio. And the more bonds you have in your portfolio, the safer the portfolio is going to be, because bonds and stocks work in inverse relationship, meaning that when interest rates are going up, bond prices are going down. And why is that? It's because of what? The prepayment risk, right? Because think about it. If a company issue out a bond, they say, you know what, we're going to pay you a 5% interest rate, right? But the bond, they have the chance to be able to call their bond back if interest rate go lower. So now think about it. Let's say interest rates are now much lower, and they are lower. They can offer you lower payments on a bond. Why would they want to continue to pay that 5% fixed if they can pay you 2% fixed? In that case, it's called prepayment risk. They're going to call that bond back. They pay your money, and they're going to issue a new bond that's going to pay you less interest. Why? Because why? The less they pay you, the more they have for themselves, right? So there's interest rate risk when you're dealing with bonds. Although they are safer, but why? They also have their cons because of that interest rate or prepayment risk. Also, you have inflation risk. If you go and buy a bond that does not pay you as high as what inflation is doing, you are actually losing money. For example, you go buy a bond that's 2% fixed interest rate, but yet inflation is 3.5%. That bond is useless because why? You are losing money because what you're getting paid is not reaching what inflation is paying you, right? And when it comes to bonds, oftentimes bonds are 2 to 3 times less riskier than stocks. That's why people who are pushing retirement, who wants more safety, have a lot more bonds in their portfolio, right? People who are much younger, let's say in their teens, their 20s, their 30s, their 40s, they have a much more higher percentage of stocks compared to bonds because they don't need as much safety. They can be a little more aggressive, right? But as you age, as you approach retirement, bonds become more important because you now need more safety. But then again, there are some people who are older, they don't care about all this safety. They are aggressive. So even though they are in their 50s, 60s, they still invest in stocks. But the whole idea is that bonds add more safety into your portfolio. And they also reduce the variability, and they also reduce the volatility in your portfolio. So bonds are very, very important. And if used properly, you can really build a very strong portfolio, right? And why are they also beneficial if you have them in your portfolio? Remember, I said they work inversely oftentimes with stocks. So let's say the stock market is doing very, very well. That means the bonds are not doing as well, right? But guess what? The moment that, because we all know stocks go up and down, right? So the times when the stocks are going down, right? Because the interest rate they're paying you is lower. Now the bonds are not having more what? Increased value. So the price of the bonds are now going higher because the rates are going down on the stock side, right? So you see how they can be a very powerful part of your portfolio, right? Now, when it comes to bonds, there are different bonds you can purchase. You can buy corporate bonds, meaning you can buy from companies that are trying to grow their business. You can buy government bonds, right? Which are the safest bonds you can buy, but they also pay the lowest rates, right? You can buy municipal bonds, meaning you can buy bonds from your city, your local state government. And why? Those are very powerful because oftentimes in the state that you're in, they are tax free. So if you have a bond, let's say from a state or city that's paying, let's say 4% fixed interest, and somebody else buy a bond that say, let's say 6%, but from a corporate bond, maybe that 4% bond might be better because when that 6% bond is taxed, it might be less than that 4% bond, right? So when you're having a bond portfolio, you can have some municipal bonds in there, some government bonds in there, some maybe inflation protective bonds in there. You can have some some corporate bonds in there. So there are different ways you can build a portfolio using bonds, right? And I hope that makes a lot of sense, right? And also, when it comes to bonds, there are different safety parameters when it comes to bonds, right? Some bonds are rated very high, and some bonds are rated very low. So, more established companies have higher rated bonds, like AAA, right, or AA bonds. But some bonds that are rated very low, it don't mean they're bad bonds. It just means that the company does not have as much credibility. And because they don't have as much credibility, they are willing to pay you a higher rate of return to entice you to what? To give them the money to be able to what? Purchase that bond. So I don't want to continue to kind of go on and on and on, but I want to kind of just get the whole idea that bonds can be a very powerful way to invest money. But it may not also be a good thing for everybody because no one size should fit all. For somebody who's very aggressive, they may not care much for bonds, right? Somebody who's very conservative, bonds may be their best friend. So it all depends on how you use bonds in your portfolio to be able to reduce and balance out your risk in the portfolio.
Yeah, and before I have a question, it'll be somebody that just tested me a question that he wants you guys to answer.
Sure,
Question is, how can I'll say, he said, can an invested in bond bring me a fixed income?
sure. So I mean,
Yeah.
that's what bonds are, right? So, brother Ibrahim, if you want to kind of touch on that, I can add something to you, like.
Yeah, sure. Yeah, and it's a great question. I Nipano
Great question.
Ebisano. Really great question because the way the savings bonds, and as corporate bonds or municipal bonds or treasury bonds, works, and it's like not Dr. Awuah no. What mom as an individual, no, you lending that company your money or you loaning them your money. And a company no I catch us say, okay, if you give me 1,000 for 10 years or for 5 years or 2 years or 3 years or 1 year, no, I will also give you a guaranteed interest rate of maybe 5%. Enti, what do you see? and a nipa na mouse assurance sa guarantee no in the way issue at the end of the amount. If you keep to your bargain, they say, Intina debi no catch say, for me to give you that, you need to hold it for at least this specific period, 1 year, 5 years, 10 years, or 20 years. It is a keeping for that long, I will give you that guaranteed amount, Into nipa no question no be answer does in a bond, give me like a guaranteed fixed income. Yes, it gives you a guaranteed fixed income if you keep to your part of the bargain, that is holding on to the bond and for the specified amount of time and or market say keep at the end for no. In fact, I have seen so many people used to like savings bonds as part of their kids educational fund, where they buy the savings bonds, and the mistake a lot of people make is what the savings bonds now they catch us say maybe the maturity is about 15 years. What should any age? One who say, okay, by 15 years, Obeko college. So this is the right time for me to take it to the bank and redeem, Unfortunately, a lot of people, it could draw somewhere in the middle now, who trust in the then they take it over there, trying to redeem it, hoping that they will get a full in a company, no guarantee. No, it doesn't work that way. Until the company promises you something, you also have a responsibility. That is keeping your part of the bargain. And once you do that, there is a guaranteed fixed income. Until dog said, would it be ever count?
Yeah, that's a great response. That's perfect. That's perfect. Greatly explained. So I don't really have anything, more to add. But as you mentioned, right, it's really a promise. It's really a promissory note if you think about it, right? For me to, hey, I'm going to issue you this bond. Let's say it's a 10-year bond. You promise to let me hold this money for 10 years to do what I need to do, but I also guarantee to pay you the interest on that. But as I mentioned, right, no matter what investment you are investing in, there is always going to be an associated level of risk.
Yes.
Just because bonds are considered a safe investment or safer than stocks, but it's safe relative to what? Right? Because think about it. Just because a company said, I guarantee to pay you this interest rate for the next 10 years. What if that company goes out of business?
Right.
Right? Now, when a company goes out of business, there's a hierarchy or order in how they're going to pay back their debtor or people who they owe the money to, right? And in all cases, that what a company has to do is that when they go out of business, they have to sell off all of their assets, and whatever money they have left, they begin to pay their investors in a particular order. And oftentimes, stockholders are the last people to get paid, right? Because remember, you are part owner of the company. So if we are going down, you are also going down with us as well. So oftentimes, stockholders or shareholders are the last to get paid in the hierarchy of when a company goes out of business. But bondholders are one of the tops to get paid, right? So that's also one advantage of being a bondholder. But like I said, there is no complete lack of risk. There's always going to be some level of risk, but it's just that bonds are safer than stocks because of the reasons I just mentioned.
Yeah, and to add a little bit to it, sir, maybe this Obi Baby said a question is what is the difference between the stocks and the bonds in the per se? Yeah. Sir, they can I establish it like the risk level, on the stock side, and say on the bond side, the risk, very minimal. There's no risk. There is a risk involved in BBA. Like the government can even default. And if they default, like for example, amount 10 years, at the end of the 10 years, the government will say, okay, because of ABC, right now, hold on for Kakra, we don't have the money. There's nothing you can do. Same thing with a company, corporate bonds, your friend is a Mako Akoto. right now, no, maybe 10, 15 years, we don't even, there's no guarantees that that company will be around for the next maybe 10, 15 years. So what about if that company falls? Then, sir, your friend is a born name and I then. And so, abba, a level no, there is a risk involved, you know. But unlike your friend is saying, stocks now, because of the markets, you know, going up and down, to me, the stock in a be what on $5, it to me call all the way to maybe $100 or $200 was source of income and no, it to me vary from there. No. Bond in idea, it is a safe investment. Usika biya no. There is the guarantee in say even if you don't get your interest in the back and the amount biya we invest in no ubetumi no back because it doesn't it doesn't go down. Unlike stocks now, echo up and down. No. Inti na debi announcer Dr. Wa stresses so much sir. When you wake kakra no stocks kakra no. Now the bonds kakra so I then at the war Asiem ho. Just because say we no cut down and I say we no market no go up and down. At least you have something safe here. You know, sir, you're guaranteed, sir. Come what may no. Ubetumi enya your friend say usika no back. But at the end of the day, no nimi risk ewo. But what level of the risk no can you as an individual, can we tolerate in order for us to make sure, say, we have that peace of mind, you know, when we go to bed. You know?
Yeah, but if I have another question from your sister, New York, sister Kus Nidia Mewahanana.
Yeah.
I say, how do I know which bonds to buy?
That's a very good question. And you know, every company is for the most part is going to issue a bond, right? That's another way for them to be able to, you know, get money from the public to be able to grow their business. But it also depends on the individual and what they're trying to achieve, right? If you prefer to get more interest, you can look at buying corporate bonds, right? You can buy a bond from, let's say, Costco, or bond from, let's say, any company that you're interested in buying, right? You just got to go and Google that company and look at their bonds and look at their bonds rate, and it will tell you, right? So, like I said, you have corporate bonds, you have municipal bonds, you have government bonds. If you want more safety and your key is, hey, I want safety, no matter what happens, I need my money to be paid back, then you could look at getting the government bonds, right? The treasury bonds, because they are much more safer. But once again, the trade-off is they pay much less return on that investment, right? I would not advise people to buy a lot of junk bonds because those junk bonds are more risky because these are more newer companies that don't have as much credibility. So you have to, as a person, analyze and assess your situation and figure out how much money do you have liquid, how much money you have in your savings account, or what are you trying to achieve. That would dictate what kind of bond you're looking to buy. Me, I'm a huge fan of municipal bonds, right? Because of the tax benefits. But also, not every state might let you walk away without paying no tax on it. So you can look at states that offer municipal bonds that are tax free, right? And those, like I said, can be a nice part of the portfolio. Or if you have a nice portfolio, you can have a little bit of all of it. You can have some junk bonds in there. You can have some municipal bonds in there. You can have some corporate bonds in there or treasury bonds. So it could be some mix of those things in your portfolio. The key thing is what percentage are those different bonds that you have in your portfolio. So like I said, I never like to make any blanket advice because I don't know that person's particular situation first, right? Before I can make that advice. So depending on maybe your age, your tax rate, maybe if you're a high income earner, you want to reduce your taxes. So buying the municipal bonds can be another way for you to be able to invest a lot of your money, but not pay as much taxes, right? But the thing about municipal bonds is that oftentimes you cannot put those in your retirement accounts. You can put those more so in your non-qualified or individual accounts, depending on what you're trying to do. So there's so many ways to go about trying to buy a bond or trying to figure out what kind of bonds you want to buy. but the key is to make sure that you self-educate yourself and know what you're trying to accomplish. What is your objective? I always say the objective of the person is going to dictate what investment they put their money in.
Yeah, Doug, I really thank you so much for your friends explanation. Also, what summarizes the whole thing, because sometimes, based on the situation, it will determine what you need to do. But also, it's the same thing with the stocks. You don't only buy maybe like Apple and that's it. And I said General Electric and that's it. And I said, wait, no. But you buy several like different companies. It's the same thing when you come to bonds. Also, for you to spread your risk around, maybe a best survey well, sir. What to wake kakra, what to corporate bonds kakra, what to treasury bonds kakra, what to municipal bonds kakra. Na onse into when you're a mixture of a sanyo many na wo portfolio because like Dr. Awuah said, treasury bonds, they are more safe. However, and because they are safe or more interest rates, tends to be lower versus corporate bonds, Into maybe I want a little bit of interest in yes, let me do maybe a little bit in corporate bonds. Let me do a little bit of for safety reasons. Let me do a little bit of treasury bonds, and answer for tax benefits, and let me do a little bit of like the state bonds and then your money. When you mixture now, and so no, it goes a long way to help your portfolio. Now there has been a question on here. I'll say. Do bonds have maturity date? What if I can't wait till the maturity date? And so another great question. And the simple answer is yes. Bonds have maturity date. Into anytime be a bonds like different maturity dates. Now one can say which one is best for me. Into 1 year, you were 5 years. You were 15 years, you were 20 years, you were 30 years. Into one kasa say, okay, sika way, maybe in the next 10 years, I can do away with sika way. So let me buy a 10-year maturity bond. And I said, no, maybe me buy college, best start in 5 years. And because of that, if my reason for buying the bonds is to save for my college there, then maybe we share akudani age. What's your time or college now? Then a bit for you to determine what your friend is a length of time and water. The second part of the question is what about matter 5 years, matter 10 years? I'm unable to wait. Then what do I need to do? Same thing. What on for 10 years, 5 years, 10 years? However, because of ahuchire you're unable to wait for that long. You can go and redeem those bonds, But remember, sir, as you redeem those bonds, sika interest I sank winya so change to the maturity date now, you are not going to get all of it. Until nobody is guaranteeing you, sir, why you 10 years, but if you redeem it in 2 years, you bet all the interest for the 10 years. No, it doesn't work that way. At some point, some places, some of the bonds, you lose like your first 90 days of interest. And I say, your amount time so when keep here, they are no crown could do you don't even get anything at all, right? You need to check into a fine print in who say, my 5 years, if I cash it out or redeem it in 2 years, okay, what interest rates in a menya bibi kra na say menya bibi. Yes, you can redeem it even when the maturity date, it's not a dent. Dog, sir, if you have a bibi or half the count.
Yeah, man, I think, sir, you made a lot of great points. I mean, the whole idea is, between you and the company that's issuing the bond, it's trust, right? Hey, I need this money for this 10 years, 20 years, 5 years, whatever it is. You promise to give me this money, and you promise to allow me to be able to hold that money for that period of time. So in return for that promise, I guarantee and I promise to pay you this fixed rate of return. So if you now go back and try to go renege on your promise now, things are going to change, right? And the company that's issuing the bond, you are signing a contract, you're signing whatever it is to get that bond. So they may have their own stipulations. As Brother Sam mentioned, look into those fine prints and know exactly what you are getting yourself into. That's why I always said, assess your finances.
Mm-hmm.
Make sure you have an emergency account. Make sure you have some savings behind you. That way, because you don't want to go invest and say, "Oh, something happened. Now let me go touch my investment." You don't want, because you are now hurting that investment. Invest money that you can allow to go for a period of time. If you know for sure you can't let the money go for that period of time now, I advise do something shorter or put that money in a safer place. You don't be very, very careful and mindful of how and when you invest your money. It is extremely important, right? And just like stocks, instead of going to this, say, go buy a bond of, let's say, one particular company, you could buy a bond fund. And that bond fund, you may have bonds from several different companies. Yes. You could buy Eurobond, right? Eurobond fund, meaning that bonds from companies in Europe compared to bonds from companies in America. Because sometimes when the American economy is going down, maybe Europe might be going up, right? Mm-hmm. So when you're trying to build a portfolio, you always diversify. Just like in real estate, we all talk about, location. When it comes to investment in stocks and bonds and other investments, it's diversification. Because at any one point, you don't know what is going to be the best. And every investment, if it's best today, it does not guarantee that tomorrow is going to be best, right? Every investment has a season where it performs very well. So the key is to always know you balance and diversify. So you're always covering your bases and you're always reducing your risk. So if you do choose to go invest in a bond, whatever term and agreement you come to and agreed with the company, be sure that you can hold on to the entirety of that bond to be able to receive the full benefits of holding that bond. Right? Yeah. So that's what I want to add to that.
Yeah, and just to
another question, so about you near Kwajo upon Maryland here. What's it? In case of default, can I get repaid?
Right. So that's what. So brother, you can go ahead.
No, you go ahead.
Okay. Mm-hmm. So as I mentioned earlier, right, and that's a great question, right? So the question was, in case the company defaults, can I get my money back, right? As I mentioned earlier, no matter where you invest money or what you invest your money in, the moment you invest money, you are automatically assuming some level of risk, some risk greater than others. But whenever a company, let's just say, is going out of business, what they're going to do is they're going to sell off all of their assets to be able to pay back as best as they can, pay back those who they owe, right? That's why when you buy a bond, well, you are lending that company money. When you buy a stock, you are becoming an owner of that company, right? So when in the case of default, the bondholder is going to get paid way faster or more guaranteed than the stockholder. So holding a bond, you are maybe top 3 or top 2 of people who get paid first before the stockholder. The stockholder is like towards the bottom, right? So that's one of the benefits of becoming or being of owning a bond compared to owning a stock, right? Yeah. But once again, the risk is there, and the more safety that you as an investor wants, the less return you as an investor should be willing to accept or receive, because you want what? Safety, right? So I hope that answers your question.
Yeah, I think so, Doctor. You've done a great job, your friends, answering that. Sir, it's here for. Said there a point I say establishes on the bond side, or so you are lending money to Obi. Okay, in the business world, your friends say, Obi busia. That's a company ni fold. That's almost take over the company now. Or more assess say, okay. Why and a company in do omoka. Inti omo do omoka no. What they tend to do is that they pay those people first. Not just say, no free then more the owners no dear more assume the risk of being an owner. But to be a bond holder, no, like Dr. Awuah said, no, onye an owner. Only the Dr. Awuah be any business. And my bonne bosia said, Je nafa boa business no. Inti say business na collapse na say ya ton business na. Ye betua me me born bosia ne first dan say me a me tencha me ye part me ye owner me ka no hunti no me azumu sa risk no nti na ama ya pese ye nyina ye hu the difference no say na be ya ade bia wo kwakoye bia no then you make sure say okay this is where I want to go. And because say wo bo bubusia nti no so catch us say wo bo me busia na me business ni fold na say mitua wo kadia then no interest rate kram de be ma nkra no be den e be ketua bi because me pesa be da wo double the pay into ade no into interest rate ni be ketua bi versus your finance and stocks no into no we hope say on this so no aboa for ye na ye hu some of the risk involved in bonds and na bonds so like we said no and yet only one wo bebre not only in US in kwana obetumi ato you can go across US you can go to Europe up to Euro bonds you can go to Asia I just said all these places into no Winya sanyuma wehina international bonds into your portfolio. It helps you diversify. Ya can wasam ya can no bebre no. Yes.
Another question based on about person one. Or say, is there any minimum amount that say winya what matter a bond and I say any amount we will be. Do you have any specific amount? Maybe say you said when you're $500 and $200, I said what am I qualified to buy a bond?
So, yeah, and that's another really, really, really good question. So the question is, is there a particular amount of a person has to have to before they can buy a bond, right?
Yeah,
that's a question, correct? So the thing here is this, right? Every bond is going to have a face value, right? Let's say maybe the municipal bond or the corporate bond or the what bond. It doesn't matter. They're all going to have their face value, right? But if you're buying into, let's just say, a bond fund, and a bond fund, you could put, let's say, maybe $500 or $200, depending on wherever company you're going to invest in, are willing to accept, right? And that might differ depending on where you go or what company you're buying from. Maybe the company that are more established might have maybe more, more expensive bonds to buy. The ones that are new companies might maybe cost you less to buy, right? I think so it all depends on the bond you're trying to buy from, the company you're trying to buy from, and what kind of bond are you trying to buy? Municipal, corporate, governmental bond, or are you buying an individual bond of a company, or are you buying a bond fund, which incorporates a lot of different bonds in that fund? Are you buying domestic bonds? Are you buying Euro bonds, Asia bonds? So all those different things, play a role. So maybe, for example, I've helped clients invest, let's say, $50 a month in a bond fund, right? That's as little as $50 a month. But if they only wanted to do, let's say, one-time investment, maybe they had to pay, let's just say, $250, right? So it all depends on exactly what you're trying to do. So that's what I wanted to add. But definitely, the thing said, depend on how much you have. You can definitely always find a way to be able to invest that money, depend on how and what you're trying to invest in.
Yeah, and another type of bond, which your friend is I can have a lot of people use for almost savings, the savings bonds, also the government issue savings bonds, When you get into like the savings bonds, like Dr. Awuah said, the face value in the detail, but on that, like the minimum, to buy, $25. You start with like the $25, and it's not you can buy so many into like not dog you can on say sisi say my top 25 this week be how you tuamika weekly into week be I can buy 25 now first now what the mail you the actual bond in ankasa Now, I have people they have like save. I buy normally a question. I see people like 25 and I say 50. No, they are no be redeem money there. But now, no, everything electronic. Until once you purchase it now, they give you like all the serial numbers and everything which you need to keep for future redemption. Until depending on the type of bond now work on. But I know, sir, like savings bonds, if you something are you interested in, the minimum to do that is $25, and you can buy as many as you want at any time. There's no restrictions on how many you can buy. It be quite up to like $1,000.
Yep.
Depending on the one who between you can start as low as 25 all the way to like 1,000 if you have the funds to do it.
Yeah. And one more thing I also want to add, right? You could buy a bond at par, you could buy it at a discount, or you can buy it at a premium. It all depends on what's happening in the economy, right? For example, let's say a company issues a bond to you for, let's just say, 5% fixed, right? And they only pay you, let's say, every 6 months they're paying you that, right? But now the interest rates in the market have now dropped, right? That means that 5% bond can be issued at a lower percentage, right? So if you now are trying to get rid of that bond, it's going to be very, very difficult to get rid of the bond because now interest rates are lower. So companies can issue lower interest rate bonds. In that case, no, if you truly by force want to sell now, you are going to sell that bond below the par value, which means you are buying that bond at a discount. Now, let's just say you have a bond issued at 5% interest rate, fixed interest rate. But like now, the interest rates in the economy are what? A certain way or higher, right? You say, you know what, man, I want to sell this bond, right? Now, at that point, the value of that bond, let's say, may be worth more. So if you want to go buy it, you are now buying at a premium. So you have par value, meaning that the value that you bought the bond for, let's just say the bond is $1,000, right? That's $1,000 is the par value. If you buy that same bond at, let's just say, 900, you bought it at a discount. If you buy the same bond at 1,200, you bought it at a premium. And that is determined or controlled by what is going on in the economy and what interest rates are looking like in the economy. As I mentioned, when interest rates go up, the price of bonds go down. When interest rates go down, the price of bonds go up. All right, that's what I want to add.
Yeah, and here for questions be or what the number again here 240-280-2633. And I say which me sending it through WhatsApp 510-931-0946. And you and I'm say you're spending time with bonds. You're making na so bonds, it's not like there's no risk involved in bonds. There is risk your friend is saying bonds more. But the question issue is when you compare that to stocks now, the risk here less. Then again, we are not giving recommendations, and because of that, go and do bonds. But what we are saying is once share with these investment vehicles, who as an individual no financial advisor make it decision. They say, what do I want to do? Do I want to do 50% stock, 50% bonds? And I say vice versa. And I said 10 here as time goes on, the next week and you better sign up another investment vehicle. You better sign account wasam. Until at the end of it, you go through then you can have like an idea. How do I feel comfortable enough? Where do I want to invest your friends and my money in? But the can say investment is something regardless of baby Awuah biano. Yes, but to say busunya bia won ware won but modern so be because there is a purpose for the bia Awuah. Sunday can ebi Awuah for college. Look, college is getting so expensive, sir. at this point, and in fact, yeah, my college, na yeah, share when now share when I want to call college, the cost versus now. One we cry, just I want to be able to pay for your friends at college, But this is the time we can start early and get ourselves into setting something aside every week, every bi-weekly or monthly, it builds up. Because so we're starting now. Imagine say 10 years when we'll best start this or college, how much what you mean I build it up and into encourage you yes, there is the risk, but the benefits, sometimes it outweighs the risk, into doing something is better than doing nothing at all. Into dog, so what any are you closing your fence state a bet to me. And that's Dr. said to me, another question.
Last question be obedient by say, what is the tax status of bond? But so anything about self say, imagine them say we person file tax bond. What is effect and what the tax filing?
Yeah, I mean it's the same way as you pay interest on a stock, right? Just like whenever you earn money anywhere, that money is going to be added to your overall income for the year when you go to file your taxes. So whatever rate of interest you earn from your corporate bonds, say government bonds, not whatever it is, that money is going to be added into your income. So every year, the companies, whatever it is, where you bought it from, they're going to send you tax documents for you to be able to report whatever income that they've paid you on that bond, right? And you're going to add that to your income, and you're going to pay tax on that, right? But if you buy municipal bonds, once again, like I said, it is tax-free, depending on where you buy it from or what city or state you get it from, right? So if you have municipal bonds, you don't have to worry because why? They are tax-free. If any other bond, whatever interest or whatever you earn on that bond, you have to pay interest on that money. So
yeah, really good at you. Also, you find say like who savings account by law, with a bank, any interest be at the amount be brought $10 be by law, no, as a bank, is it 10?
Yeah, it's like it's like 10 or 10. It's a tax form they have to send to you to show that.
Yeah. Yeah, you show just this interest, now they file taxes.
Yeah,
it's the same thing with bonds, even though the maturity date no money catch on say
10, 20 years,
20 years any investment at the end of a yearly, the company will send you a tax statement showing this is the interest that be all the way up to this then you use that document to file for taxes. Now a be in fact say with 1 year wako redeem bank na tua de na that interest na beka ho at the end of the year bank will send you the tax documentation na what the account your friend is away you now. The difference maybe what way like all these stocks, bonds near there and IRA near there contribute say me the 10,000 share bonds and as stocks now me as an individual you don't have any tax benefit. Unlike say a year friends IRA government say because of your age 6,500 better what is 6,500 which me at every income now tax brackets and I lower it is not the same thing with bonds and stocks in the idea. So nipa no question if that's where nipa no is heading towards then never say a trend say once you lend now there's no tax benefits to you. Say what lend you basic but womomu and interest the amount as a taxes.
Any investment that is not considered a qualified investment, meaning employer sponsored or government ordained to have a deferred taxes or no tax in the future. No. Any investment outside of that, no, you're going to pay yearly tax on it. Does not matter. It all depends on how the government identifies that investment. If it's qualified like a retirement account, you're fine. You don't have to worry about tax for now or tax when you put the money out, right? But any like a stock, bond, mutual fund, whatever, if that money is invested outside of a qualified plan, you're gonna pay tax on it yearly for sure. They're gonna say in the document you're gonna file with your taxes. So, Mr. Four, I think it's your time now. Drew said it'll see it's a point show though. But as always, we are so grateful. Say we can come here, we can share the information, and we are grateful for all the questions because that questions, and the boy my show need to be more exciting because we can give you guys real life scenarios of how to benefit and how to do well when it comes to your finances. So I for the past 2 weeks, I've thoroughly enjoyed the show because of the questions. So I urge you guys, say next week in Pacho, more questions and Brian because that's going to help the show to be able to go on more smoothly, and all of us going to be able to enjoy, and we're all going to learn from each other. So, brother Asiem, you have anything you want to add before we close?
Yeah, thank you, Doug, for your friends. And really, and I mean, it's always a pleasure, for us to come and share information. Yeah, the amount, no, it is share information at your work, but so we hear any advice be outside here, you can call us. We'll be able to like talk with you on like one-on-one. Yeah. But then again, as we always say, bank BR, they have financial advisors there. They can also help you with some of these decisions. Sometimes don't follow their obika. Say, Makoti say we okay, we koto bonds when you're going to let me also do the same thing. No. Something might work for Mr. A, it wouldn't work for Mr. B. It all boils down, sir. Now assess all your financial aiming now. Who the right advice and direction to give you. Inti yadamwa say numere so no munya time na money eshia. Nyame yadomwa next week in same time 6 o'clock. Yebesan eshia biem ewo say inti yebesan according to a different investment vehicle. Not just at least year two. A third one or maybe a fourth one next week if time permits. Na ye investments in not just say at the end of it, we'll be able to make that conscious say $10 na me talk Burger King every week, Maybe let me put it aside and do some sort of investment. I bet me name nyame enka mu na onshram ti until say you be share be more next week, nyame enshira mu hina.
Kosuwa na ti era one radio empenyini say